Have you ever watched the news, seen the stock market going up and down like a roller coaster, and wondered what that really means for your money? It can feel a bit unsettling, can't it, seeing those numbers change so quickly? Well, the impact of volatile markets on investment portfolios is primarily about short-term uncertainty and emotional challenges. But for disciplined, long-term investors, it often presents opportunities for growth rather than guaranteed losses. It essentially means that the value of your investments can fluctuate significantly and rapidly. The core mechanism behind market volatility stems from various factors, including economic data releases, corporate earnings reports, geopolitical events, and shifts in investor sentiment. When there is uncertainty or major news, investors react by buying or selling, which causes prices to swing. Think of it like a crowded room where everyone is reacting to a sudden announcement. Some might rush for the door, others might stay put, creating a lot of movement. This movement in the market directly impacts your portfolio's short-term value because the prices of your stocks, bonds, or funds are constantly adjusting to new information and collective investor psychology. It is important to understand that volatility is not necessarily bad. It is just a measure of how much price variation an asset experiences. In fact, risk and potential return are often linked, meaning that assets with higher volatility might also offer greater potential returns over longer periods. So what can you do when markets get bumpy? First, try to stay calm and resist the urge to make sudden, emotional decisions, especially panic selling. Historical data shows that markets tend to recover, and selling at the bottom can lock in losses. Second, continue to diversify your portfolio by spreading your investments across different asset classes, industries, and geographies. This helps cushion the blow if one area performs poorly. Third, consider dollar-cost averaging, which means investing a fixed amount of money regularly, regardless of market conditions. When prices are low, your fixed investment buys more shares, and when prices are high, it buys fewer. This strategy averages out your purchase price over time. A fascinating insider detail is the Volatility Index, or VIX, which is often called the market's fear gauge. It measures the market's expectation of future volatility, and a high VIX usually indicates investor uncertainty and fear. Another key concept is distinguishing between a market correction and a bear market. A correction is typically a drop of 10% to 19.9% from recent highs, while a bear market signifies a 20% or greater decline. Understanding these nuances helps you contextualize market movements and avoid overreacting. It is also crucial to recognize the role of behavioral finance. Our emotions often lead us to make less than optimal investment decisions, like buying high and selling low, which is the opposite of what long-term investing principles advise. Ultimately, successfully navigating volatile markets boils down to maintaining a long-term investment horizon, staying disciplined with your strategy, and understanding that market fluctuations are a normal part of the investment journey. By focusing on your financial goals, diversifying wisely, and practicing dollar-cost averaging, you can turn market volatility from a source of anxiety into a potential pathway for portfolio resilience and long-term wealth accumulation. It is about playing the long game, even when the short-term waves seem turbulent.